Hello everyone, you're listening to Gold Block Career, your personal finance and personal growth podcast. In this episode, we'll be tackling the question of what we can expect from the next financial recession, but most importantly, how you can take advantage of it and the best way to profit investing in the cheap market when the economy is at its lowest. As you are probably aware of by now, many financial experts have been speculating the next financial recession for several years now. The last financial crisis took place around 2008, caused by the subprime mortgage and banking crisis in the United States. More than a decade has now passed, and it still remains quite uncertain when the next financial recession will hit. Some say it will be next year, others that there will be a few more years of prosperity. It's all a game of speculation. But what is in fact true is that at the time of this recording, we are in the longest economic expansion in recorded history. The economy has grown for more than 10 consecutive years since 2009, surpassing the previous record between 1991 and 2001, before the dotcom bubble burst. Is this why people fear that the economy will be soon hit by a recession? It will happen sooner or later, but what do they back their suppositions on? Is it just simple fear? Or are there any tangible measures or evidence that can prove their point? Well, you're going to learn about what is actually going on in the economy and what factors experts are using to predict this next financial recession. But before that, we need to understand what a recession is. The media keeps talking about the next recession. This has been going on for several years. The 2012 recession, the 2013 recession, and now the 2020 recession. All this propaganda and clickbait is used to improve ratings for their shows. They are a business after all. Alright, so a recession basically occurs when the economy suffers negative numbers in GDP for 2 consecutive quarters, or 6 months. GDP, or gross domestic product, is measured by the market value of all the products and services produced in the economy within 1 year. The economy of the United States, the largest economy in the world, is estimated at around $21 trillion for the year 2019. Okay, now that we have a rough idea of what everyone is talking about, what are the factors that support this idea? It's clear that the economy is doing great. Unemployment numbers are at the lowest in history. In fact, for the first time in history, we might even reach a zero or negative employment rate. This is not economically intuitive at all, but it occurs when the supply of jobs is higher than people searching for jobs. Currently, the unemployment rate in the United States is around 3.6%. There is a high overconfidence in borrowing money due to low interest rates. In fact, the Federal Reserve or Central Bank of the United States cut the interest rates 3 times in 2019, hovering now around 1.5 to 1.75%. People and businesses are starting to borrow more money from financial institutions since interest rates are so low, incentivizing people to use credit cards, get student loans, car loans, mortgages, and so forth. In case of an economic downturn, it will greatly amplify the recession since people are going to start losing their jobs and being unable to pay off their debt, producing a domino effect. What we do know for a fact is that the world economy is going through what's known as an inverted yield curve. This means that interest rates are higher in the short term compared to the long term. So let's say that you purchase a government bond that yields a 1.5% rate of return in a year. However, if you purchase that for 6 months, it yields 1.55%. You're getting a higher return on investment in the short term. This is usually not how the economy works, and it is a reliable indicator that a recession is forthcoming. Investors see no future growth, which means that the US economy is slowing. This is usually the case in past financial crises. However, we can't just assume this single factor to cause the next recession, but we also can't dismiss the possibility. The longer the yield curve is inverted, the higher the possibility of a recession. We must focus on the various factors that constitute the financial health of the economy. unemployment rates, business profits, and consumer confidence. The central bank's purpose is to try to mitigate the effects of a recession with the various tools, such as cutting interest rates after the dotcom bubble burst. However, in the Great Recession of 2008, the interest rate was so low that they couldn't cut them below 0%, so they had to come with what is known as quantitative easing. I know it's a big word that usually makes people divert their attention to anything else. Simply put, the central bank injects money in the economy. How does it work? Well, a central bank prints money to buy bonds from financial institutions. This creates an excess of demand in the bond market, which lowers interest rates, allowing businesses and people to borrow money at a lower cost, increasing consumption and making businesses create more jobs, allowing for an acceleration in the economic growth. Other frequently used tools are stimulus packages and public work programs such as the New Deal of Franklin D. Roosevelt used to tackle the Great Depression. The stimulus package signed by President Barack Obama back in 2009 in response to the Great Recession is estimated to be around $830 billion between 2009 and 2019, used to increase public spending, most of which was allocated to tax incentives, healthcare, infrastructure, education, and others. This helped reduce unemployment rates. They are basically measures to prevent entering into deeper recessions, but remain debatable as possible solutions. Another big factor that is unique to this next financial crisis is the rise of technology. Just as the Industrial Revolution led to a cheapening of goods, in this new digital revolution, technology has allowed a democratization of prices. This means that increasing technological advancements are making goods and services cheaper and more affordable. That means that if you buy 100 pieces of an item for $100, and in the next year you buy 100 pieces of the same item but for only $90, you would have gotten what you need for less money. That's great for consumers. However, the GDP of the country will be lower since people are spending less. Add that to the early stages of artificial intelligence and robotics that are way more productive, allowing a higher output for a lower cost, possibly jeopardizing physical labor and increasing unemployment rates. All this being said, it still remains incredibly difficult to time the next crisis. We can only speculate as financial experts continue to do so. However, I wouldn't have made this podcast if that's all there was to it. What we can do, in fact, is to take advantage of the opportunity when markets are down. This doesn't mean that recessions are good times to look forward to. On the contrary, people lose jobs, can't pay debts, struggle feeding their children, and risk getting evicted. Not good times at all. We also need to be aware of double-dip recessions, which is a recession followed by a short-lived recovery and followed by another recession. So, how can we take advantage of recessions? It's quite simple. Two things. Don't try to time the market, and put money from your savings into the market every month. This is what's known as money cost averaging. You aren't waiting to time the market and invest in market lows. You just invest every month and average out in the middle, gaining a considerable rate of return out of it. This is the safest and best way to invest in a recession or an economic boom. However, sadly, this is not what most people do. It is true that the general objective is to buy low and sell high, but that's incredibly hard to time and requires hours upon hours of investigation and expertise. Actually, the most common thing that happens when people try to time the market is to buy high and sell low. They might see a stock at its highest value and begin to invest a ridiculous amount of savings after it has peaked, in the hope of making a quick and large profit out of it, only for the stock to suffer all-time lows afterwards, market crashing, people panicking and get scared because they need the money and manage to lose 50% of the value buying high and selling low. This is usually what happens in speculative trading. There's a great quote by Warren Buffett to illustrate this. Be fearful when others are greedy, and greedy when others are fearful. So forget about following the crowd. Start investing every month regardless of the circumstances of the economy and enjoy the benefits of money cost averaging. A recession only acts as a great opportunity to invest more since the market is cheap. That is why it's important to also have cash available to invest. You can even make several bank accounts, one for your main expenses, another one as an emergency fund, and a third one as money to use to invest. The third one may be debatable since people want to invest directly without waiting, but it's a huge bonus to have some liquidity and cash in hand in a recession to start investing in cheap market stocks. Just remember to combine this with investing every month as well. You don't want to try to time the market, expecting there to be a recession and waiting for years without any sign of that recession, losing on all the potential profit you could have made within those years. Investing also depends on your age. The closer you are to retirement, the lower your risk tolerance. Investing in risky assets can affect your decision to retire, since you might not be in the right moment of the market to cash out. That's why you should focus more on safer stocks, such as blue chip stocks, utility or consumer staple stocks, rather than speculative stocks. If you are far from retirement, you should have a high risk tolerance, investing in diversified stocks such as the S&P 500 market index that enjoys a 7 to 8% rate of return over the long term. And what about precious metals such as gold and silver? Lots of people exchange cash for precious metals in their portfolio when a recession is forthcoming. It's mostly used as a wealth preservation strategy that doesn't have the same growth as the market. You can think of it as money that can't be used but that grows in value over time, contrary to the fiat currency, which can be traded anytime you want, but you lose purchasing power parity due to recession, which means that your basket of goods get more expensive by the time. You might want to invest a small percentage of your money into precious metals. This totally depends on your personal preferences. Remember that the key to invest in a recession is controlling your emotional behaviors, not panicking when you see that the value of your investments are going down. It is just the cycle of the market. There are always ups and downs. When the market is down, it's just an opportunity to invest more since the market is cheap. Okay, so a quick recap of this episode. At the time of this recording, we are experiencing the largest economic expansion since the dot-com boom, and people fear the next financial recession to be relatively close due to this reason. Some factors that prove the next financial recession are the inverted yield curve. Long-term bonds give less rate of returns than short-term bonds, signaling an economic slowdown. Technology is going to play a huge role in the next recession due to AI and robotics and other technological advancements that are more productive and can substitute physical workers. We can never predict the market and we shouldn't aspire to do so. What we should do is to invest every month and enjoy the benefits of money cost averaging, regardless if we are in a recession or not. A recession gives us the opportunity to invest in the cheap market to later enjoy huge profits during a recovery. Those who are able to understand these strategies and invest in a crisis without succumbing to irrational fear will be rewarded with high rates of return during a recovery, thus profiting and taking advantage of a recession. Share this podcast with your friends and family to take advantage of the next financial recession. Please like and subscribe to this podcast as it greatly helps me to keep producing content for you. Thanks for listening. Until next time.